pleasure being here. Thank you very much for the DIFC and for hosting us at this event. We're going to discuss the future of venture capital. Where is the innovation? Broad statement, and we'll delve into that. By way of introduction, my name is Bahoshy. I'm the founder of MAGNiTT, a venture capital platform for emerging markets. And I think what's been interesting to kind of delve into this subject matter is that when you look at it, there's two sides of this equation. Will the VC model as a business or asset class slow down, change, given the current dynamics that we see? And when you look at the current state of innovation, is there something that needs to change in terms of the perception and the research and development into that? To give a little bit of context before we jump into the conversation, and I've asked all my panelists to give their opinions and to challenge each other as we go along. And looking at the MAGNiTT from data, I mean, we've expanded the coverage into emerging markets, and I think that we're in a very interesting point in time when we compare what's happening globally and into the emerging markets. If you characterize where we're sitting here in the MENA region as a 10-year-old ecosystem, 8 to 10, depending on who you're speaking to, and what's the first VC that was investing here, and that exits typically take 7 to 8 years to come to fruition. We're literally coinciding what is an economic slowdown and a venture slowdown with that exit window. If you look at CB Insights, for instance, in their recent report that was published for Q1, you've seen 8 quarters of decline starting from Q1 2021 in terms of venture transactions and capital beginning to go down. And there's a lot of questions being asked with regards to the impact of interest rates around venture capital as an asset class. At the same time, many VCs are looking to raise funds from LPs. I had a fascinating conversation with Sharif just the other day, and we were discussing how more than ever we're seeing fund announcements, but that capital isn't necessarily getting deployed into startups. So to try and unpick all of those challenges and to kind of have a little bit of concept around where we are specifically here in the region, where FinTech, the same as globally, is seeing more investment in capital than any other sector, we'd like to dive into some of those subjects. So to kind of go straight into it, and Sharif, just to maybe start with yourself, we've seen a liquidity boom off the back of the post-COVID era. We've seen growth in terms of venture dating back almost 10 years, year-on-year record amounts. And yet now we're seeing a big slowdown in that activity. When we talk about the future of the VC model, let's talk about the history of the VC model. What have been some of the drivers towards what was happening going into 2020 in terms of venture capital and investments in startups globally and in the region?
Thanks, Philip. It's great to be here. For me, I think the fundamentals of venture capital as a model are very strong, and I think I'm one of the purists who believes that we shouldn't stray too far away, but at the same time, there are some innovations that are exciting and much needed to provide liquidity, such as secondaries, and in the region here, maybe increased M&A culture, grant culture, R&D that comes before our initial investments, and a number of other things because we're not a very mature market, as you mentioned. But generally, I try to avoid the noise of disrupting VC because the models become so outlandish and don't really add up from a portfolio balance and the timeline and the risk assessments that we have to make. So I don't think it will change drastically. I think the core will always remain, and I think in general, what happened post-COVID, or it started even prior to COVID, is too many people got into entrepreneurship, too many people got into venture capital that maybe didn't really embody the core tenets and culture of the asset class. We're starting to see a bit of that fall apart. There were a couple articles just this week that were already posted about that we should expect to see a number of funds shutting down. And from where we sit as a capital allocator, at least in MENA, I certainly think that's the case. If you look at pillars of performance, the way they treat founders or their ability to matriculate companies from one stage to another, any of those pillars you look at, some funds just don't have any of them. So it doesn't make sense that they're around. I think in the US that started about 18 months ago. Of the 3,000 or 4,000 VCs that had emerged, I think half of them won't be able to raise the next fund, and that's probably pretty healthy.
So, yeah. If I can continue, Melissa, because I think it's interesting. We were just discussing before coming on here, and You have experience in Southeast Asia, obviously experience in the US as well, and we were going back to the 2001 crisis and then talking about the 2008 crisis. I mean, are there any lessons learned from those in terms of venture as an asset class? Because for so many here, the region hasn't experienced an economic slowdown that coincides with venture. I go back to the 10-year evolution. Is there lessons learned then, or are people quick to forget and we revert back to a business model that Sharif is saying already exists and is solid?
Well, I think, yes, I'm old enough to remember the 2001 downturn. I entered venture in 2000, and it was the nuclear winter. We lost almost a third of the industry pretty immediately. People gave back money. I think it took the industry to 2008 actually to recover. And we went through a pretty dry period where it was pretty difficult and people were supporting their existing portfolio companies. And then 2008 happened, but I was in Asia in 2008, and it wasn't much of a cycle at all. And this is the first time Asia is actually experiencing a downturn in the market, a real downturn in the market, very similar to what the US experienced in 2001. I think there's always lessons to be learned, which is, unfortunately, people jump in on the hype and the market gets super frothy. And then reality sets in, and people have to realize it's a lot harder to build a company than it appears. And I think Sharif said it, right? A lot of people came into venture thinking it's easy. It's not easy. It takes 8 to 10 years to build a real company, and you have to have a lot of patience, and you got to go through, it's like sausage making, right? Or being on a rugby field. It's a battle for companies to truly scale. So what are the lessons learned? I think at the end of the day, you got to stay focused on building a great company. And that's it. And that's how we are. We've never changed our investment pace. It's 4 to 5 deals per year. That is it. We don't chase. We have a thesis. We're a FinTech fund only. So we have very specific thesis, and we continue to follow that, which is why our returns, including our DPI, is quite good. But I think what happens is too many people come into the industry, think it's easy, and then as things get difficult, they have to get out or they don't raise another fund. This is just healthy. This is cyclical. Our business is cyclical.
I mean, to that point, just to double click on that, do you think that the business model of venture as an asset class changes, or is it just a blip in time and that we're going to see a slowdown and then it picks up again if interest rates, for instance, were to come down again in 12 to 18 months?
So when we get into a market that's quite frothy, the industry attempts to shift from being a craft, which I believe it is, and I think Sharif was sort of lending to that, versus a AUM game, right? We're not private equity. We're not public market investors. We're building companies, and perhaps venture, I believe venture is a craft, and it takes time to develop that. So yes, the industry shifts from being a craft, and I mean, what I'm talking about are $500 million or $750 million funds, till you see these multi-billion-dollar funds in the Valley, which is extremely hard to deploy that type of capital and achieve the multiples that still make you very competitive, versus you could just be in private equity if you're going to have the same multiples.
Joe, come from a UK perspective, I think it's great to have different panelists from parts of the world. I mean, obviously a far more mature market that's been around in terms of venture for several decades. What's the word on the street that's happening in the UK right now? And specifically on the point of government, what does the government's view of venture as an asset class change in this type of environment? Are they supportive, and are they taking specific initiatives to kind of weather the storm?
Yes, just in terms of...
I think if you can, the mic, sorry, just move it a little bit
closer.
Yeah.
Okay. I mean, just in terms of the UK, I think, we have had a really challenging couple of years. Post-COVID, companies have, funding's dried up, companies have really, really struggled. So we have had a bit of a window, but I think, what's happened is you return to fundamentals, which I think is really, really important. You start to look at companies again, how you should be looking at companies, which I think is also important. With relevance to the UK, I think we continue to harbour back to some of these core ingredients which make FinTech and venture thrive. And us as VCs, we provide one element of that, which is funding. You absolutely need a supportive government, and you have changes in government, but maintaining that support of government. The second one is regulation and the regulator, and often those come together. But making sure you have a regulator that sort of really promotes competition, promotes innovation, promotes sandboxes, thinks about AI in a constructive way, thinks about, distributed ledger technology in a constructive way. And then the other thing is universities and talent. Making sure, you're bringing talent domestically through, through your universities. And, the UK has, I think it's 19 out of the top 100 universities in the world. US has 26, and, they're very different size, economies. But then also bringing in that talent as well, and being open enough to say we might not be able to accommodate everything, from that perspective. And then the other thing is welcoming in the incumbents or the global financial services businesses. And this is the one thing London's done really, really well. Like, almost every financial services firm in the world has some presence in London. And we sometimes forget that only 11% of FinTech is actually designed for disruption. Like 70% is actually designed to be like sold to existing financial services businesses. So having that really like important core of global financial services institutions where you are or in your market is huge in terms of.
And I just want to, on one point of that, but at the earlier stage. So late stage has been the biggest hit because of the cost of capital implications, and late stage funding has somewhat dried up. Some could argue that early stage is a lot more attractive because they're going to have to weather the storm of 7-8 years, and if you give them enough capital for the next 2 years, it's a much smaller ticket size, and potentially they can be a lot more leaner. The UK has a phenomenal mechanism for early stage angel investing. Yeah. Can you share any thoughts on how that is being kind of supported in this type of environment that can at least, maybe you don't see the record numbers in terms of capital deployment, but at early stage, it continues to support those university entities, students, and people that are driving innovation? Is there anything there that could be learned from early stage investing as opposed to late stage?
Yeah, I mean, so I think firstly there's a load of second-time founders that are starting to come through that are basing themselves in the UK that are interested by supporting and working with the next sort of generation of companies. There's also a huge number of financial services professionals that have personally made a lot of money and are reinvesting that back into interesting fintech businesses as they come to the kind of sunset of their career. I think there is also a lot of the CVC market that also supports those companies as they start to get slightly larger. I think the big challenge that we're trying to solve for at FinTech Growth Fund is when you get to sort of Series B, Series C, and you move into that growth stage. And I suppose that's a demonstration of the maturity of the market, but that's not something we've done so well. So not only do we need, growth stage expertise, it's a very different form of investing to, picking the right team and the right idea. It's growing these businesses. The other thing that's happening is the government's actually mandating more and more organizations, so whether it's pension schemes that are kind of government pension schemes or defined contribution pension market, to invest more in this growth stage. So again, the government's being highly supportive around, how do we transition from being more of an earlier stage, sort of fintech market or VC market into that latter stage and pushing that capital in that direction.
I think it's interesting from an AWS perspective. We made a prediction at MAGNiTT at the beginning of the year that corporates in the region will come and account for almost 20% of all institutional investors in startups in the region. Unlike VCs or having to raise funds, often corporates can have off-balance sheet investments and or set up funds within the organization. What are you seeing in terms of yourself and your peers where valuations are far more depressed than they may have been in previous years as opportunities for corporates to play in the venture space?
Yeah, I think we're starting to see that trend pick up. But before I go there, I just want to comment on some of the earlier discussions, if that's okay. I'm a lot more bullish on what's going to happen over the next 10 years here. I think, you mentioned that we're an emerging ecosystem, and just like the rest of the world in terms of the funding data we see and you publish, it's mirroring what's happening. But I think what's different is that with this rebasing, and we have 10 years of experience now, we will start to see things change a bit in the sense of the mix of our investors. So I think we will see more founders enter the investor space. We will see more technical folks enter the venture space. And with this dry powder that Sharif mentioned at the beginning, I think it will be more competitive for some of these best deals. And these differentiators will have to help and be there. So I think cutting out this noise and this rebasing will help the region produce some really quality startups over the next 10 years. Back to your question on CVC, I think what has happened, a trend that I see with the CVCs that we work with in the region, is that over the last 12 to 18 months, they've been staffed up with the right talent. So you see more and more senior talent join these CVCs. You see funds earmarked separately for them, and deal activity starting to pick up. And I think it reflects a prioritization with a lot of these entities, whether it's telcos or banks, that simply wasn't there before.
And I'm just intrigued, because obviously, ahead of startups at AWS, you're seeing their spending. So when funding begins to slow down, is there a change in the startup behavior in terms of spending? How does that impact potentially the business? But more importantly, and interestingly, that I'll come on to speak to other people, are you seeing people geographically spread wider than what was more focused on a region into other markets to kind of get to scale where capital is a bit more restricted?
Yeah, I think so. A few trends. So one is the most immediate and obvious one is we see more and more startups focused on cost optimization. So in the past, when the dollars were flowing freely, there was less focus on building your stack efficiently or optimized for cost. Whereas now that's ramping up quickly, and you see it more and more in a priority with the CTOs and CPOs we work with. I think second, what is interesting is we see a lot of inbound around generative AI and how to use generative AI to save costs on the business. The easy starting point is a chatbot, but depending on the business model, we see more and more use cases that are heavy cost lines for the business being automated. And I think when it comes to expansion, we see more focused expansion. In the past, it was entering a full region. Now you see more and more of startups building prioritization models around which country they want to enter, and are doing it country by country versus multiple at a time.
Sharif, if we flip to the other side of the statement, which is what's the future of innovation to a certain extent. We had a candid conversation last week talking about the copycat culture versus innovation that's being born out of the region, the evolution of startups that are now going to get investment. What do you think that VCs are going to be looking for in the next, let's call it 2 to 3 years, as opposed to what they've been funding in the last 3 to 4 years that may be different?
Well, I don't know if it's because, Kat, which one comes first, but I'm hoping that we're laying down foundation for a few things at this time, like foundations for R&D and grant culture, and we're voicing opinions. I mean, not every VC is, but we're voicing opinions that we want to see depth in certain sectors and verticals. We want to see move the envelope deeper into technology, whether it's healthcare or FinTech or any other sector. It's not that the days of the copycat models are gone already, but I do think that window will close in the next few years, and it won't be the biggest arbitrage opportunity or greenfield that it has been in the past, and we'll have serviced the gaps by then. And I think the only thing that's going to be left will be for founders to create real deep businesses within these sectors, and then by default of that, the investors will have to switch gears as well.
And I guess, Melissa, actually combining what Sharif is saying and what Joe was mentioning earlier from the UK, Southeast Asia, going to Singapore, having gone there myself and spoken to the government, every mandate at the government level is deep tech. Everything's talking about deep tech, deep tech, deep tech. And to a certain extent, to get into deep tech, you need the education, you need the patient capital, you need research and development. Do you agree with that rhetoric, or is that something that you don't agree with in terms of focus on the next evolution of sectors? And is there things from Southeast Asia that we could potentially see or learn from that could be applied here to further develop some sectors beyond the infrastructure pain points that have been solved for historically?
Well, number one is I would not follow Southeast Asia. It's actually been not successful for what they've done and all the money they've poured in. But that's for a variety of reasons, because people talk about Southeast Asia, but how many languages do you have, right? Here you have a common language, which is Arabic, and then you have English. In Southeast Asia, you have Vietnamese, you have Tagalog, you have Mandarin, you have Bahasa. I mean, it's not, they always talk about it as a region, but it's not really one region. I think, I just want to back up. The reason we started coming here in 2018 was because we looked at how much money was going into Southeast Asia, we looked at the population, we looked at other dynamics, and it turns out there was less money coming into this region than just Indonesia. And so we were like, Southeast Asia has been completely overfunded for the opportunity set, given you just don't have one market, where here it's really underfunded. I would like also just really back to what Kartik said, which is actually, if you think about venture, it used to be 100% of the money went into the US, and then it became 50-50, or if you want to just say the bigger markets between the US and China. And I think now with what's happening in the world, East versus West, Dubai is option C, which means this becomes the center of financial services globally. And I really believe that, and this is why we've been building our foundation here for so long. I don't think you want to compare yourself to Southeast Asia. I think you want to say, that Dubai becomes the financial center, and it can serve either East or West. It's perfect from a time zone perspective. So I always think about looking at other places. You can learn what's worked, what hasn't worked. But, we're in a different world today than we were 5 years ago or even 2 years ago. I don't think you necessarily want to replicate, just like companies should never replicate something that was somewhere else specifically, but you really want to look at this as the center for the future for financial services, and I believe that.
And I'm interested, you're saying this because it coincides with a slowdown in funding that people need to look opportunistically elsewhere?
No.
Or is just the evolution of the region from a tech perspective has made it more appealing than it has historically?
I think it's the evolution. It's the evolution of a geopolitical environment that's changed dramatically. I don't think, Southeast Asia has never been that exciting, actually, from a venture perspective. China, yes, absolutely. Maybe, but not Southeast Asia when you look at our returns and the ability to scale. Look at the tech talent, it's lacking tremendously in the region. That's why everybody has engineering teams in India or in China. Or you have to, there's no deep tech per se in Southeast Asia. I think what you have here is a really unique circumstance where you do have a system that has favorable immigration to bring in engineers from different places. You're halfway between East and West, and you have a place where you can really build a global company. That's not possible in Southeast Asia. They can't even build companies across ASEAN.
So then, Joe, coming from the UK, are you seeing a growing level of interest of either VC investment directly into the region and or companies from the UK scaling into the region?
Absolutely, yeah. Like it's, if you think about, those 5 or 6 like core ingredients I talked about earlier, like I completely agree with you. The Middle East has all of those in abundance. Supportive government and regulator, it has funding, it has universities, it has talent coming in. And so, I think it's very, very natural. I think you could see, you wind forward 3 or 4 years, and you could see kind of it as a major competitor to the US and, the UK in terms of the FinTech kind of ecosystem. I think it's going to happen quicker than.
But what about the challenge that, and I remember speaking to maybe an investor in Southeast Asia who said, if you're not operating in the US, China, or India, then it's impossible to try and get scale because of some of the challenges that you mentioned for Southeast Asia, multiple geographies, multiple bureaucracies and government initiatives, etc. Are we now seeing that there is US, China, India, and then this emerging venture market that you can operate that crosses borders because we're more interconnected than before? And that's actually to any of you that might have an opinion on this.
Well, China has had a massive downturn. And that's probably going to continue for a couple more years, just unless something dramatically changes. So I just think the world has changed, and you have to look forward, not backwards. That's why your windshield is bigger than your rear view mirror, right? You have to look forward, and I think looking forward, China environment has changed dramatically. Southeast Asia hasn't proven out with the returns. The US, who knows? It's a big election this year, could change things pretty dramatically, maybe not. It'll always be a place of innovation. Partially, actually, to what Joe said, 70% of all founders in Silicon Valley are immigrants. So so people have to realize it's just because it's been a very open to welcoming tech talent from around the world. But I don't think you can look backwards in venture and say, this is how it's going to be. And maybe something was emerging, it's no longer emerging. I don't think China is even considered on the IFC list anymore as an emerging market. I think you just have to look at the world and say, okay, it's a lot, it's just definitely geopolitics has changed a lot of things. US companies are not going to be able to sell globally like they used to. Gen AI regulation is going to be by region. And we have to be forward-looking to what the world might look like, not what it has looked like in the past. And I think that's true of technology, and venture is all about change. Otherwise, if there's no change, we don't do very well. We do really well when there's lots of transformation and discontinuities.
And you see it with the large VCs actually voting with their feet, right? So they're all opening offices outside of the US is what they're doing, whether it's London or whether it's here, or their presence is growing in certain areas. So they're doing it with their feet as well.
But interesting, so again, anyone can jump in, but I'll start with Sharif. From an LP perspective, we talk about the future of venture capital. Historically, a lot of the funds, and we were just discussing it before, Southeast Asia, you had to invest in Southeast Asia. And there's many restrictions in some cases of where these people can make investments. Do you think that that needs to be loosened in the concept of that if the company is originated out of somewhere, but then starts to operate cross-border, cross-geography, that we're getting to a point of scale and transformation that isn't restricted by geography and actually into multi-geography continents?
Yeah, I mean, this is a topic that's been frustrating me for a while until I realized that that was the case in the US and everywhere else. So in the 50s, 60s, 70s, when venture capital was being supported by the US government, it was for the US. I mean, these technologies were for the US, mostly in defense. When we look at any pockets in Europe of LPs or institutional capital coming in from the government, it was developmental. So it was frustrating because we started to see that here, even though we try to treat a multi-country heterogeneous region as one region from a GP's point of view, fundraising for that kind of a fund became increasingly difficult as governments propped up, which you give them credit for, propping up deployment programs. Because then all of a sudden they either have to earmark their fund or change their domiciling or any other kind of hoops that they have to jump through. So we scratched our head a little bit and said, like, why are we doing that here? That's not great for us. Until we realized actually it's happening, it was already happening everywhere else. And even more so, I think pensions and endowments in the US are mandating their GPs to only invest in Delaware US companies as well. Then you see the next layer you mentioned, which is the founders, trying to navigate this sort of maze will jump through the hoops to get their company where it needs to go or where they perceive it needs to go, and will move or set up licenses or move people for the chance to increase their funding or to get some kind of incentives or rebates. To me, it's pretty worrisome that founders would move for those kinds of things and not follow what the roadmap says they should follow. But again, I understand both sides of the equation. Now that I'm sitting in one of those seats, I understand that this developmental money is meant for certain, strategic purposes for that region or country. And then we have this tug of war between the craft in venture versus KPIs that we need to check box. And that's the worry is you don't want it to become a machine. You need to continue to be a craft. But I think I wanted to say earlier, these differences we're talking about are blimps in the longer term horizon of venture because it is a very long game. And even venture capital as an asset class, it's not one 10-year fund, it's multiple 10-year funds across regions and vintages. So I think when you look at it like there, it's a really stable asset class. But when you look at it in a microscopic view, that's when we start to have all of these discussions about the ebbs and flows in different regions.
And I guess, Karthik, again, we were discussing it outside. You're speaking to your colleagues that are going to be in other geographies. They can support in many ways, whether it's through, obviously, cloud services, but you can also support in becoming customers and or acquiring, potentially, entities that are interesting in the propositions that you're interested in. Is there something that you are seeing now in this current market that makes it insights from what you're seeing from other geographies?
Yeah, I think one that I'm particularly excited about is obviously the US is largest in terms of venture capital flows and has been for a while, and we tend to see when it comes to new verticals forming, they tend to be first. I think one thing that I'm particularly excited about when I look at EMEA is that the success of generative AI startups that are coming out of France. And the government played a big role in enabling those startups. And as we work with entities here, I'm really excited to bring those learnings here because there's multiple entities that are interested in that vertical growing. And I think we're well positioned to capitalize on that. So that's one that I'm particularly excited about.
I just want to comment on one thing. Innovation in FinTech does not come out of the US. Innovation in FinTech came out of Asia, whether it's an online bank, payment system, QR codes, even embedded insurance, all of that came out of China first. And that's really where the innovation in FinTech. The US has been a follower and a slow follower. There are now 70 real-time payment networks around the world, India obviously being the largest. The US is still in the pilot phase and having failed on Zelle. So when it comes to financial services, the US has not led the innovation. It's been coming out of the East.
Yeah.
Sorry.
So one more trend that I think, and thanks for correcting me on that or reminding me that I'm excited about is that, again, when we look at the EMEA space, MENA's ranking in terms of FinTech funding it's gone up the list. So it's a second only after UK when we look at last year. And I think that's something that will continue to be there for a while.
There's a very big fight in the buy now, pay later space. As VCs who are speaking to their startups, how can you help foster innovation within those companies in this type of environment where there is a slowdown in venture to kind of employ a longer term perspective and growth over the next 2 to 3 years? Are there any changes in terms of advice that you're providing to them to kind of weather the storm? Sharif, Melissa, Joe.
I mean, I'll just make one small comment because that's a difficult one. In the 90s, late 90s and early 2000s, when I was trying to build companies, we weren't just building companies. We were trying to discover something in technology that would provide value. And I don't really feel like today's founders are really focused on that. So it was a technical first kind of initiative. And I think if we can go back to that, it would be much better for the ecosystems. I'll just leave it at that. I mean, I think that's what I'm hoping for we do with the deeper stuff. I mean, we're using this deep tech term as a catch-all, but it really just needs to be that the technology itself is leading us to better solutions than before. There is the business model innovation sort of phase that we went through post the first internet boom bust. But I don't know, I mean, if that's going to be able to carry the weight for the next 10, 20 years, is just keep innovating on the business model side. I think it has to be a little bit of both.
I mean, I'd say the slowdown has actually been an incredibly good thing for companies in and around their focus. I think the mega rounds are gone. The ability to raise when you wanted to raise off, a variety of different metrics, depending on which one looked best, has completely gone. And so, people have refined their strategy. It's incredibly focused. They have cut their workforce. And so you actually, I think, have really, really healthy companies. In terms of like how we're helping startups, I think one of the key things that we're thinking about is how FinTech goes everywhere over the next 10 years. And I think other industries have been very good about inserting basically payments underneath their businesses. But I think the sectors that FinTech will get into over the next few years will increase dramatically, and the opportunity set will increase dramatically. And it's how can we help, a banking as a service provider go and speak to an e-commerce bank, or go and speak to, it might be an automobile company or whatever it might be, because I don't think you're going to have to deliver more than just a payments. And I think they do require help to move into those other verticals.
One thing that I'd add is it's not only the investors giving advice to the startups. I think they're also now in a very different environment and may have had different advice 24 months ago, whether it's around growth or what to do next. So it's very much a joint conversation, and I agree with Sharif. I think the technical piece is important, and I would love to see more of that come into the ICs in this region and the venture partners.
Conscious of time, and I want to leave it open for questions in a second. Last question, exit. So obviously, the business model of venture is all based on getting the liquidity event at the end. Currently, we are seeing clearly a slowdown in exit activity, although for 2 years now, I've been predicting that there would be a return to record levels, but actually that's just not coming to fruition. IPO windows in the US have yet to kind of come to full force and unlikely anytime soon. Is the business model of venture likely to change at least in the next 12 to 18 months if we don't see a return to exits, or do we just have to be patient and that window will come at some point in the coming years? Melissa?
I mean, I think you have to expect, and we have expected, that the market won't return to 2026. So companies have to make it through. But we are selling positions in secondary still. There's plenty of money around. So if you have a really good company, I think we've been able to sell. We have one position in particular. We're selling it at our carrying costs. We're not taking a significant discount. I do think companies have to wait till 2026. You'll get some IPOs out of highly profitable companies, but for the most part, you just got to make it through the cycle.
Just one interesting point on that from a UK perspective. We already talked about 70% of fintechs being designed to sell to incumbents, but actually over the last 5 years in the UK around growth stage, 70% of exits have actually happened to trade sales, so i.e. the large financial services firms buying the fintech businesses. So that importance of solid partnerships, provides you with a path to liquidity. Only 10% of businesses have actually IPO'd, and 20% is kind of gone to private equity. So the importance of that strategic capital, talking to it, and almost seeing a path to liquidity is incredible.
And that's a question, that was my final question. Is there an opportunity for private equity players in the region to have a much bigger role than they have historically in the tech space in the next 1 to 2 years? Sharif, I don't know.
Yeah, absolutely. I mean, they need a lower return threshold than we do in venture. And I think if you have a nicely growing company at the Series B to E stage that doesn't go through a trade sale or IPO, a PE could easily pick that up. I mean, by then, the company should be EBITDA positive and have really strong economics. I don't think this is a numbers game. I don't think we're looking for quantums of thousands of companies exiting per year. Then we would be moving away from the craft again. I think focus on one company doing really well. This year, fingers crossed, I mean, it was supposed to happen before, but all those black swans happened. This year, I think we're going to see several very large exits in the region, and they're going to make the previous exits pale in comparison in size. So it doesn't matter if we have a lot of them or not. If we have 1 or 2 or 3 per year, and we're investing in very selectively in these businesses, we'll have a healthy ecosystem. And the portfolio balancing that the VCs do is how the returns will come to the LPs. They don't need to see every company in the portfolio or in the ecosystem succeed. And mind you, I think you know this better than I, but we've been tracking the regional exits for maybe 10-ish years, and they've been increasing in size and frequency. But whether it's here or globally, I tend to think that 70% of what you read in the papers doesn't tell you the full story. So whether it was here or US, believe it or not, when I was there, most of the exits are fire sales, and people are not making money on them. So we don't really need those headlines. I think what we just need is really strong fundamental companies, take them all the way to the end, because without that, if you have 10 that are medium successful versus 1 strong successful, 1 will make the ecosystem cycle continue, the 10 won't. So we have to focus on the fewer, more successful ones.
And then you'll get the entrepreneurs coming out and doing it again. And that's what you need for a real ecosystem development, right? Success begets success. But you don't need thousands. You need a couple that really do extremely well.
Yeah.
Great.
So just don't forget there's a stage in between venture and PE, which is growth. And I think we forgot about it in the UK and we didn't do it very well. And now we're trying to fix it. We had a lot of venture and a lot of private equity. We didn't have that growth to connect the two.
I think we'll just take 2 questions. Is there a microphone or any questions that people have?
Hi, thank you so much for a very interesting panel. This is Prateek Bagaria. I'm a barrister at the DIFC court in the Singapore International Commercial Court. It was lovely to hear the panel's view on which markets are doing well and not doing well. There was a comment that Southeast Asia is not a good market. And so far as US is concerned, also the growth is going backwards. And Middle East and India are the names where I heard growth is going well. From your perspective, how important is the ability to enforce contracts in choosing those markets to enforce. Because Southeast Asia and America, at the end of the day, what you put your money in, you can get it out. DIFC today is doing better, but other markets in the region, and especially India, are very low on contract enforcement. How difficult does it make for a VC to make a decision where you can't get your money out after you put it in?
Well, that's the sales point of Singapore, right? Is that you have legal precedent and that you have the ability, but you still have other regimes in the region. I mean, Singapore is not a big enough market for venture to matter. You have to have Indonesia, the Philippines, and maybe Thailand. I think it's not a concern for us here. I would say there's no difference for us here compared to Singapore or Hong Kong or the US, for that matter.
Any other questions? Take the last question.
I will, in the meantime, just add to that. Like, in the whole time we've been investing here in the region, or I have, in the last 8 years, every company that we're investing in, we make sure that they're domiciled in a jurisdiction that is respected by lawyers and the investors globally. And there's only like a dozen or so globally. So we happen to be really lucky and have two, and you mentioned DIFC, two in the UAE from the get-go, based on common law, makes everybody much more comfortable. The bank accounts and the movement of money in some countries in the region, yeah, it's challenging, but we're finding solutions to bridge them.
Philip, Gabriela, and Santis, X2 Ventures. You've mentioned before about driving innovation when there is less capital to be invested in startups. So from venture capital perspective, we have few people here. What VCs can do at the moment in order to grow sustainability and growth for startups when there is a limited capital?
That's the VCs.
I'm not sure what the
what
question
can
was.
I wasn't
VCs
sure what the
do to
question
help
was.
startups get to sustainability and growth when there is a lack of venture capital?
Well, you want to build a company to be sustainable, and that comes down to burn rate multiples, revenue to revenue growth. But I mean, if we're talking about sustainability, I mean, as I think Sharif and as alluded, I mean, there's those companies that stepped on the accelerator as fast as they possibly could because they were easily getting funded. But we do B2B FinTech only. That's never been the case. So being sustainable from the beginning and having a plan and understanding what success looks like, and then when you need to go raise, is absolutely key. But people have been focused for the last 3 years now on really what's the appropriate burn rate, because capital is tight, but that doesn't mean it's impossible. People just want to see the right ratio of revenue growth to burn rate. I mean, there's never been a more exciting time. I mean, the best time to invest in venture is in a downturn, not when the market's frothy. This is a great environment to start a company in.
Thank you.
Amen to that.
Thank you very much, and thanks to each of you.